just a question to the people that present on economics presentation, but like if you think about sort of DM and EM, like a lot of deficits being printed at the moment, right? Globally, and the CBO estimates I think of 2 trillion a year for the next 10 years, right? So how do you see that funded across the globe? Do you see that coming from private markets or also debt monetization, and not just in the US but globally? Because that doesn't seem to be abating. Do you want to go first?
Great. Okay, for you and then Toby.
Yeah, thank you. Yeah, I think probably I can share my understanding for US and for China as well, especially for these two countries, which are the two largest economy and which also have like the fiscal policy hot topic, I would say, right? So for US, our in-house view is that obviously the higher government fiscal deficit will be a drag to economic growth, both cyclically and structurally. True, in a cyclical point of view, we see the fiscal issue will be a problem, given the higher for longer interest rate environment means that there will be higher fiscal burden for U.S. economy. However, if we look into the decades ahead, from a structural point of view, we did a very solid analysis, run a lot of deep modeling-based analysis. We see in the most likely scenario, the AI-boosted productivity growth, which is a mega trend for decades long, will very likely outperform the demographic drags and fiscal drags in the longer term. So this is our, based on we have several scenarios. This is the most likely scenario. So this is for US. For China, true, you also see the news, the Reuters, I think, yesterday, Reuters just released a news saying there will be likely more than 10 trillion RMB policy stimulus down the road. Maybe for next week, after the National People's Congress Standing Committee meeting, we will see what the numbers will be, right? However, we believe that this policy pivot is a good signal, and it's a good direction. It's a good move in the right direction. However, we believe those fiscal resources will shift from the local government balance sheet to central government balance sheet. As we all know that in China, the local government debt burden, the local government debt issue has been very severe, and the central government have to behave as the lender of the last resort. So the central government will have to bear the burden of the fiscal stimulus and do the heavy lifting and try to figure out a way for the local government debt resolution down the road.
And do you see that being funded by the Fed and PBOC, or do you see that being funded privately through an institution?
I believe that will be funded by China's central government balance sheet. True, if we look at the debt burden faced by Chinese government, most of the debt issue or debt risks is on the local government side, not the central government side. China's central government, I would say, is the most wealthy, richest central government across the major economies in the world. So the central government have to, do the heavy lift. Of course, the PBOC, which is the monetary policy maker, so they will continue to ease the policy, continue to cut the interest rate. But the role of monetary easing is to facilitate the fiscal expansion. So the heavy lifting is still on the fiscal side.
Yeah, anything you want to add?
Yeah, it's worth bearing in mind that next week, between the 4th and the 8th, there's a big policy meeting in China as well around fiscal policy. So we'll probably get a better answer on that. But there is definitely a desire at the moment for the PBOC to help the government issuing bonds and then bailing out the local governments and transferring. And it's interesting because you've already seen that post-GFC in the developed world, where you had a lot of the bank bailouts from financial crisis then increase the public debt burden to a greater or less extent in different countries. And now you've got a situation where the inflation targets are really important, around 2%, because that enables you to sort of inflate your way out of the debt to a certain extent. It's a question of degree and how fast the deficit expands. So if you take, for example, just looking at the post-GFC period of austerity, compared to then, I think in the financial crisis, we've seen that fiscal policy is really powerful compared to monetary policy on that front. But there's no monetary authority at the moment that's saying we want inflation, these prices, as they've risen post-pandemic, to actually go back into deflation, to actually, the cost of living is not going to go down. In real terms, it'll be good if it goes sideways. So they're still trying to inflate that away to a certain extent. I think part of the danger with Trump's plan is that if you weaken the economic impulse in terms of demand coming from the lower income households, then you're putting more emphasis on monetary policy and inflation in order to be able to fund that deficit. And there are signs that there are concerns building in that area, and you'll also see probably more monetary debasement. You probably see more demand for gold, more demand for cryptocurrencies and Bitcoin in that scenario. So it's always a question of degree, because it's always happening to a certain extent. But I think, in the outcomes that I put up there before, a Trump and Republican undivided government would be far more inflationary and far more reliant on monetary creation.
So I've got a sort of follow-on question from that, because it seems to me that of the macro drivers, the US federal deficit in particular is the big macro driver. So Steve, you said we try to insulate ourselves from macro issues, but this year, US federal deficit running to say 10% under Trump is such an issue that it's got a flow-on consequence for companies, the cost of debt, the availability of debt. So how do you factor that sort of thing into your model and your approach to companies?
Yeah, I think the big challenge around this deficit issue is just one of timing, really. If we think about how long have we been talking about the US deficit being an issue, I think probably 5-6 years ago it was a challenge. Certainly 2 years ago it came back again. From the perspective of the way that we're trying to make money by outperforming benchmarks, taking a bearish stance on that back then would have been a recipe for disaster. So, I think the reality is that my belief is that things will be pushed down the road further going forwards. And rightly or wrongly, I think regardless who comes in, there will be spending. There will be spending. How that's funded, I think, is going to be interesting. But essentially, I find it difficult to see that good quality US companies, listed companies, are going to struggle in that kind of environment, certainly in the next 6 to 12 months.
That's great. I have a quick question for a couple of the guys on the panel. With, just having a look at valuations at the moment, just thinking about the themes that we have, and looking, a lot of performance has been driven by valuations. We start thinking about earnings, and potentially, to what extent do we think that future performance, to what extent do earnings have to start catching up, and how's that going to play out? I think maybe Toby, I think very interested. Steve, yours, Brad, your guys' view on that in particular.
I can give you the top-down view.
Top-down view, absolutely, and the more granular bottom-up.
I think it's really difficult to build a good, reliable macro model that predicts earnings, for a lot of reasons. But there are a few variables, sort of, new orders on the ISM manufacturing versus some of the coincident variables that you might see in industrial production that generally give you a better read. And these are all areas that are saying that it's looking pretty grim. And for perhaps ex Magnificent Seven, the chances of having sort of double-digit earnings growth over the next 3 years look slim to none. So you have to look at what sell-side estimates are with a lot of skepticism. And the only way that the market multiple as a whole makes sense is if you're going to see sort of 10 to 15% earnings growth for the next 3 years and then beyond. So that gives you, from an equity positioning perspective, some pause for thought and caution.
And maybe Steve, if we can just talk from your perspective, and then Brad, really keen to get your perspective on that as well.
Yeah, whilst I definitely don't disagree, I think for me, valuations is one of those things people love to talk about, investors love to talk about valuations. We love to talk about valuations, especially relative, but they really only become a key focus when they get very extreme. And if we have a look at where we are versus history, even though we need earnings to come through, I did actually put a slide just showing versus trailing earnings. So this is delivered earnings and not really what's priced in. Most of the regions are sitting above average levels, but they're not at extreme levels. The exception to that is large cap US tech. And we all know what's going on there. That's interesting to see the last couple of days from those big names have actually been delivering that earnings. Further down the cap spectrum, even though you're still seeing relatively elevated P's, etc., regardless of the metric, I don't think it's in that territory where people are really saying, "I've got to get out of the market right now." That's fine.
Yeah, that's great. And Brad, did you get the question?
Sure.
Yeah.
So, I continue to really favor the more dynamic growth stocks. Clearly, that favors the US. The US has the best flow of capital towards the most disruptive, the most dramatic growth, the most evolving companies, and we have the best demographics, and I think that will continue. Europe will continue to be sort of like the museum state. Japan, to some degree, maybe even China eventually, sort of, is an aging population. They have draconian rules in China around capitalism. So all those things bode particularly well for open capital markets like the US. And then just to sort of rest the valuation question, our largest stock for the last couple of years has been NVIDIA. NVIDIA's up, 180% this year, but earnings have moved from, barely $1.25 to a number that's going to be, close to probably above $4 next year. So, that's nearly fourfold. And so the stock is up twofold. We're not viewing the markets and particularly discrete securities like NVIDIA, like Microsoft that reported today, Meta or Alphabet that reported last night, as being excessively expensive. There clearly are a lot of uncertainties around, short-term events like the election. But in the end, whoever wins, the market will be fine. Short-term events around, how quickly and how large Fed cuts are. In the end, it's really going to be up to these enterprises disrupting, delivering, and outpacing their competitors. And that, is what we do at Axiom. And I think we have some parameters, some risks, and most importantly, evidence-based metrics that we look at to make sure that we're not caught flat-footed with that. So I continue to be constructive, notwithstanding obviously big moves in the market this year.
That's brilliant. Thank you so much. And just one quick follow-on, then we'll just pass back around on that. Is there any lesson or is there anything that yield curves, I think, Toby, we've spoken about this prior, and I think you did say that we had a slide, but what are yield curves telling us in this respect? I might just see if I can get it.
Yeah, sure. I don't know if everyone can see that. On the left-hand side, I'll just talk you through. Thanks, guys. So the dashed pale blue line on the left-hand side is the US Treasury curve at the beginning of the financial year, so 30th of June. Before we were looking at the Fed cutting possibly in July, and then it didn't. Then the darker line at the bottom is 1 month ago, and then we have earlier this week. So you can see that there's been a steepening in the yield curve, basically. The front end has come down as the Federal Reserve has cut by 50 basis points, but the long end has moved away and sort of back to where we were at the beginning of the third quarter. And I think that's kind of interesting because it does suggest that, and the movements do track how well Trump has been doing in the polls. So there's definitely some risk aversion around the deficit, possibly a view on growth as well. We've also seen a couple of numbers come out like retail sales and unemployment, which have been a little bit more, at least in the headline, although you could pick them apart underneath. The headline's been pretty good. So there's still more volatility in the yield curve around the debt ceiling negotiations, but at the moment, the bond market is saying, oh well, this it seems to be saying this Trump possible victory is kind of problematic where yields could be, and that's caused a couple of other knock-on problems. One is that you have issues of financial stability becoming a problem with the banking sector again. So the banking sector in the US still has more than 250 billion of unrealized losses, according to S&P Dow Jones figures. So that is a concern. If you start to push longer-term yields up and they go a bit further, then you start to have those issues around financial stability again. And on the right hand, in the middle, that red line there is the option implied volatility from the MOVE index. So you can see the bond market volatility and the chances of something going wrong are much, much higher than what's implied in the equity indices as well. So you've got the pale blue is the normal US VIX, and then the green one is the Australian one as well. So that's going to have an impact on how much market, liquidity is available. And I think one of the things that I try and do when looking at likely scenarios is trying to understand how we got to this situation where we go through a pandemic and we've got very, very high multiples. And to me, it doesn't necessarily look like it's 100% a risk-on trade. One of the indicators of that is the fact that you've got a lot of money crowded into a small number of stocks that have got a long runway of growth. But also, if you look at the amount of liquidity that was created during the pandemic on the right-hand side, there's sort of spilled over into this reverse repo facility at the Federal Reserve. When we had that interest rate rise in 2022, it was obviously not so great for multiples, but then we've had more than $2 trillion worth find its way into markets over the last couple of years, and now it's down to sort of just over 200 billion, with the US deficit in terms of new bond issuance running about 1.8 trillion per year. So this is running out quickly. And this is going to be like a weather change when that gets down to zero, because all of a sudden, this excess cash that's just been available to fund the deficit is now going to have to be pulled away from other areas in the market. So this is something that we're really concerned about. So the impact of the bond market on liquidity is we see higher yields, more volatility, and then more credit issuers coming back to raise finances as their pandemic bonds are turned out in 2025 and 2026. Means that from a liquidity perspective, the environment for equities probably gets a bit more challenging from here.
That's great. Ben, more questions here.
Isn't the key what's prices of markets? I mean, you talked about sort of yields and volatility partially reflecting sort of growing expectation of a Trump win, perhaps. And similarly with equities, I mean, I saw a survey the other day that suggested that investors are more positive on US equities than since that survey's been going, I think 2.5 decades.
Yeah.
So forth. So, you're seeing gold and Bitcoin sort of moving. So the key is sort of not an economic scenario or even the policies, because, but what is actually priced in markets in terms of what's going to matter for asset prices from here.
Well, it's not fully priced. So, I mean, 100% agree with you, and that's why we're not going very long into duration, even though the economic outlook isn't that great. So there is this movement in the yield curve which could be quite negative for bond prices. So fixed income positioning is neutral at the moment. On the equity side, we're aware that we need to take risk off the table, but with this possibility of the tax cuts coming through, that's going to be an immediate injection into the market of risk appetite. So I think you'll see a run up there, and then that's probably the time we look into liking positions rather than taking risk off the table before we go into the election next
I
week.
suppose my concern is there's a lot of sort of simplistic looking back to 2016. Trump's positive for equities, therefore, everyone, there's a melt up to come in US equities.
Well, that's where
Trump.
that's where liquidity comes in. For me, I mean, the simple way to look at it is that if you look at the sort of underlying GDP and economic demand conditions, that tells you roughly where earnings are going. But liquidity is really determining where the multiple should be. And obviously it's relatively high at the moment. I mean, not as high as it could be, but it's relatively high. And, that's really where we see the risk, just basically, earnings being lackluster relative to expectations, but more pressure on the multiple coming back down as well.
Got a question for Graham and Brad as well. You have US productivity growing back to trend. Why wouldn't that grow above trend if some of these AI and other technological changes come through? Because there's enormous investment going on at the moment.
Yeah, but this actually is a very, very good question. So we are saying the productivity boost gonna moderate, but it's just a cyclical view. I agree with you. Like, there's no doubt that over the longer term, like once the AI boost, once the AI fully adopted by the US economy or by the global economy, there will be a structural change. There will be a structural strong boost, which will outperform other headwinds, including fiscal, including demographic.
Have you got an estimate for that?
Yeah, we estimate, like I mentioned, like we built up a very big, economic model to run different types of scenarios. And all our like modeling-based analysis point to the view that the most likely scenario in the longer term, I mean decades long, is that the AI-boosted productivity growth will outperform other types of the cyclical or even longer-term drags, will give us the, I would say, optimistic future of the world. And but cyclically, we see cyclically, like the short term, like the driver from the productivity is too moderate. That's our like in-house view. And also, I agree, like, we are not there yet because, AI boosted productivity growth and the AI boom requires a huge amount of investment. And we are far away from that. We are not that yet, but one day will come.
And Brad?
Sure. I concur about the long-term view on AI. We're just past the Wright brothers era in terms of where AI is. We certainly many years away from the jet age, and that really will dramatically impact where the world's at. The scaling laws of AI, the effect of these incremental tenfold increase in teraflop processing really will cause AI to transform the world as we know it. And that'll take a while. It'll take an incredible amount of capital. We're certainly seeing that in terms of, the Mag 7, and that is clearly, one of the questions that investors have to digest. And we have to also pass as to, who the direct beneficiaries of the capital spending are. Obviously, so far, NVIDIA have pretty much taken the lion's share of that. But our view is that the combination of both secular and cyclical benefits from AI and the effect of monetary policy broadly around the world in a cyclical fashion becoming at least neutral and probably a tailwind everywhere except for Japan will really allow the markets to weather many of the uncertainties and many of the natural frictions that, we, with our implementation from Pengana and the International Equity Fund, have really taken advantage of this and used the 4Ds, basically disruption and technologies that allow us to find these highly dynamic stocks and offset that.
I actually had a question for Steve as I was listening to Grant talking about the central case of being AI. And then, Steve, you talked about the way in which you absorb, process, and reflect on, whatever it was, 3 million pieces of information a day. Is AI part of Vinva's kind of present or future to do that?
Absolutely. We're big believers. There's no question about that. And we've been using AI to help us with investment for probably the last 15 years. Going forwards, I think it will be quite a revolutionary impact on a lot of industries, including investment management. But I guess because we use it a lot day to day, we're a bit less likely to get caught up in the hype, I think. And I feel like it's a little bit like where we were in 1999 when we were all so excited about the internet. But the reality was that it took a bit of time, and it took probably the best part of a decade before we got to where we thought we were going to be in March 2000. So I think that things will be progressing pretty quickly, and the ability for people to integrate AI into the way that they work and that workflow is going to be quite revolutionary. I think it's going to take a bit of time.
My question was really directed at your own internal processes rather than AI as an investment.
Yeah, so I mean, the way that we use AI, I illustrated a little bit with those macro documents. Every single bit of research that we can consume, we use a number of different large language models to process. Some of them that we've worked on and developed in-house. We try to leverage that across a wide range of different sort of data sources. Every single conference call that management have, we like to listen, in inverted commas, to all of the news items, the way that we're consuming and processing that information on scale allows us to do what we do.
That's a question leading on from that. More technical for Steve. So you've got a lot of inputs going into your models, right? So you're necessarily operating in high-dimensional state space here. So one of the issues with that is multicollinearity, right? Confounded. So how do you think about that problem set? Do you use some sort of PCA model to sort of reduce the dimensions of that model? Because that's a real issue, right? In modeling this stuff out, is you've got a lot of covariates there that are interplaying between each other. And so if you go down the path of using like a CNN or an RNN, and then you've got issues around that, right? Regime shift, things like that. So how do you think about that problem set?
Yeah, I mean, when we're building we didn't really get into it in the presentation, but obviously at the core of our process, we have, we call it the model, but our stock selection model, which looks to combine a whole bunch of different data, which is, I guess, converted into factors, for want of a better term, signals. When we're doing that signal development, a huge part of that is making sure that a signal is orthogonal and adding something which isn't in the process already, and it's absolutely critical because we see that, you think that you've got 20 great signals, but you realise you've got one underlying signal and it's telling you the same thing, and you're suddenly getting into this situation where it's actually detrimental to your ability to forecast at different turns. So, we have a research team, a dedicated research team, and a big part of what they do is looking at trying to isolate orthogonal information and factors and signals.
Just a question for Brad. You've been through quite electoral cycles. And usually, which we didn't see a chart unless I missed it, usually we see charts showing the stock market under Republicans, under Democrats, and how it performs before and after the election. And you see that every electoral cycle. So I'm just wondering, in your experience, is this different, this electoral cycle?
Sure. I think the key thing is that markets can outperform depending on the various permutations, whether it's a red or a blue government, and whether they have the House and the Senate. I think really the key thing around the election is markets hate surprises, and we've clearly had a couple of course reversals. We clearly had, one set of actors, and then a change in the players, and a very dramatic swing in what direction the market, who they thought was going to win, and that's now completely reversed. So I think what's key in the short term is markets don't like surprise. So if we were to get a completely blue sweep on Tuesday, the market will clearly respond to that. On the other hand, if the market pretty much gets what it's expecting without anything too extreme, it'll then begin to digest many of these factors. And I think the other key variable is that we really don't know all the players. We don't know who, certainly who's going to win, but we certainly don't have a lot of clarity on either side's policy. There are lots of headlines about tariffs, about various tax incentives, but in the end we don't know the answers, and most probably they're going to be far more modal. The distribution is not going to be in the tails. It's going to be much more a continuation of some of the status quo that we've seen over the last 8 years, and markets tend to adopt that and take that pretty well.
If I can just add one thing or ask you one thing, obviously you're sitting in the United States, which is different to where we are, so you're a lot closer to it. Is there a scenario, or do we need to be aware of a scenario? What happens when an election is contested? I think there's a thought here, certainly you read everything we read, that it's likely to be contested, or there's a high likelihood of that. Is there anything there that you're seeing on the ground? Is that an overreaction, or is it something real, and how does that play out potentially?
So, in my investment career, we've been through two very big contested elections. The Gore election around 2000, I recall, and obviously the last election in 2020. Clearly, a lot of oscillations, a lot of volatility in the market. But, looking back, certainly 6 months, a quarter or two beyond that, they tend to be a blip on the horizon. And for us, fundamentals trounce, the companies that are executing will do very well. In the short term, the macro in the shock does disrupt markets and shakes out a bunch of folks. But importantly, if you're a long-term investor, if you don't try and time the market, these events really are just blips in a general trend. Looking back, maybe even a month after that, but certainly a quarter or two after the event.
Thank you. Any more questions? We wanted to start finishing up. We said we would finish around about 1:30 and then have a bit of time if people wanted to talk to people offline and do a bit of networking. But Lou?
Yeah, just a question on markets. I've seen some statistics around that sort of suggest that there might be liquidity that's holding up markets, or like, is there a reason for that strength? I'm wondering if you have a view on that, whoever wants to answer, and whether or not that poses a risk once that liquidity sort of dries up.
From a macro view?
Yeah, I mean, that is the chart on the right-hand side, is the indicator, and you can look at sort of financial conditions indices. You don't need to have access to Bloomberg or Goldman's. You can look at the Chicago Fed ones. Track versus Bitcoin, it's, very, very highly correlated. So I would answer the question, this way, since we've clearly got so many quants in the room, but if you look at the explanatory power of liquidity relative to market prices over the last decade, it's much better than anything else, basically, particularly with that recent. I mean, Steve talked before about, yields pushing up for the inflation response in late 21, 22, and that depressing multiples, but then you had the liquidity going on. We've got a really unusual situation from a macroeconomic perspective I've never seen in my lifetime before. I don't think anyone else here has, where you've got central banks ostensibly shrinking their balance sheets at the same time as they're cutting interest rates. So the whole sort of orthodox theory was around the financial crisis that you were supposed to get interest rates down to the zero band. When that didn't work, you did QE, and then you brought QE, you paid back QE, and then you started to raise interest rates. And that's absolutely not what we've seen. So no one really knows how this is going to play out. But there's been some stealth liquidity created by the Treasury as well as the Feds with maturity swapping in the US Treasury market, and that's propped it up. And it does seem to look that there are clues there that Treasury policy has aimed to keep liquidity at a good enough level to support the stock market up until the election. But then once we start to get that down to zero in the reverse repo and liquidity is a little bit harder to come by, all bets are off. And we'll have to see how the Federal Reserve responds to whatever's in front of them. I suspect if they relaunch QE, it'll be because, as the IMF has outlined, that's really their tool for responding to financial stability concerns rather than a cyclical slowdown. So if you have just a normal slowdown in the economies, you should see interest rate cuts continue and maybe a pause in QT. But if you start to see banks getting into trouble with losses, they're experiencing defaults at the same time they're underwater in their US Treasury, then there's a stronger argument for intervening from a stability perspective, and you could see QE relaunch. So it's definitely things to watch there.
Just a question on global trade. Apparently the EU's gone over to talk to China about the EV tariffs situation. But given that China's in deflation, it's about a third of global production. I mean, how do you see that playing out?
Macro sense, and then
the theme of deglobalization, right? Tariff hikes as part of that.
Yeah.
It seems like this is an attempt, right, to sort of open trade up.
Yeah, of course.
Go the other way.
Yeah, of course. I think basically that's, I guess, like your view, your question points to the two sides of one coin. Like on one side, we can see, true, there's, as you mentioned, there's a big globalization trend, like the volume of the global trade actually, have already receded from the peaks after the GFC or even before GFC, right? And especially like the impact of, like, say, we talk a lot about the Trump scenario. And we guess like the biggest risk from Trump is from like the trade policy, like the tariff rate, mainly focused on China, right? Trump threatened that he will just propose like the tariff rate against Chinese products to 60%. So based on our estimation, that will drag China's GDP growth about around like 1 to 1.5%. Anyway, based on like how you estimate the impact. However, what I want to see is the negative impact from the trade policies is for sure. However, we should look at the zoom out a little bit and look at the broad picture. China's economic connectivity to US also declined. So this decline comes from both sides, from the US side, from the China side. So for US, China has no longer been the US largest trade partner, and Canada and Mexico, they step up, and the EU as a whole also step up. So China becomes less important to US value added in terms of GDP accounting. On the China side, the US importance also declined. The ASEAN economies, especially the emerging Asian economies, becomes the largest trade partner for Chinese export. And also EU becomes more important. So this is one view. And as you mentioned, the EV tariffs against Chinese products like from Europe, from US. However, if we just look at the EV, and we can see that the share of EV in China's total export is not that big enough. So it means that in addition to the final products point of view, if we look at the global supply chain, the value chain perspective, we can see China actually is trading more intermediate products far more than like the final products. So it means that China is still firmly embedded in the global value chain. And if we look at the global value chain perspective, rather than just the global trade perspective, we see China's role in the global value chain is strengthening, not declining.
But isn't that a function of a greater China policy by the Chinese government, which is to encourage Chinese manufacturers to own manufacturing in Vietnam, in the Philippines, in Malaysia, in Indonesia. And so the fact that the direct China-US relationship may have shrunk doesn't mean that the greater China-US relationship has shrunk.
Yes, exactly. As you mentioned, US is buying less products from China directly, and US is buying much more products from Vietnam, Mexico directly. However, Vietnam and Mexico, they are buying more products from China directly. It means the US is still buying more product from China indirectly.
Yeah.
So this is the role of global value chain.
There's another element to it as well, and if you just look at sort of Japan, EU, and China, one thing they have in common is their current account surpluses and declining internal demographics. So they need the external markets, and that's motivating them to take a more nuanced view when it comes to global trade. So for the European Union's perspective, they will put quite tight limits on what can be traded with China from a security perspective. But the Germans are very, very dependent on the Chinese market for car manufacturing and other things. So they have to reach a compromise. Whereas the growing demographics in places, particularly the US, but then also Australia, New Zealand, and Canada as well, they can afford to stand off a little bit more.
Volkswagens are not like lobsters. In the sense that we can tolerate it.
Yeah, but I'll tell you, anecdotally, my wife's German, and just watching the European Soccer Championships, and everyone driving around in BYD cars was absolutely. It did not go down well in the home market, I can tell you.
Look, that's fantastic. I think we're coming up to the end of our time. I'll just check with all the presenters, maybe Brad, starting with you. Is there anything you wanted to add before we wrap up today?
Oh, just great to join with Peng Ghana, and hopefully we have a decisive outcome next Wednesday. That would be great news, and I'll leave you with that.
Thank you so much. Thank you, Brad. And from everyone that's here, maybe some of Toby, anything?
Just one more really on sort of the contested side of things. I mean, if you want to view on the polls, I mean, they can be bought to a certain extent. It does look like Trump has a hard ceiling of 47%. The population of the US is 53% female. So it does sort of lean slightly in Harris's favor, providing she can get all the Puerto Ricans to turn out. But the thing that follows on in 2 weeks' time is that Trump's due to be sentenced in New York before the end of November. So I don't think, whatever we get the result on Wednesday morning here next week, it's not going to be the end of it.
Yeah, nothing really further from me other than say it's an anticlimax because
That doesn't mean not the best outcome, is it? So we worry about it, we just sail through it and it's in our rearview mirrors in 2 months' time.
Yeah, thank you. For me, I think, especially for my coverage, next week there will be two important events. One is the U.S. election, obviously. The other one is like the National People's Congress Standing Committee meeting. We will see like how big the fiscal stimulus will be, like what's the number will be, and we can better gauge like the impact of those two offsetting scenarios, like higher tariff rate and stronger fiscal stimulus. Like we will see. Hopefully it's a positive outcome.
That's really good. And Toby, thank you for helping us arrange and organise this. And thank you everyone everyone that's taken the time to come in. We really appreciate it. I think these sorts of things are always good. Gives us a chance to hear from a lot of experience from different counterpoints and things like that as well. So to the presenters, thank you so much. Really, really appreciate the time.
Kieran, thank you for your role in hosting.